room so full, actually. Given the circumstances, this is not really given. Yesterday it was not always like this. No, so it's really a pleasure. My name is Miriam Gartzon. I'm moderating through this session today. I'm actually working for the GIN as a senior advisor. The GIN is a global network of impact practitioners. We have 400 organizations as members. And the goal actually of the network is to promote impact investing, to scale it, to make it more efficient, and to provide tools to everyone to use impact investing in a meaningful way. This is only part of my work. I have my own impact investing consultant company working here in Switzerland with impact asset managers, but also with investors. I would like also to quickly not introduce, but mention that we have some physical hosts here and also remote hosts, guests, excuse me. We have Fabio Segura from Jacobs Foundation, Lucas John from iGravity, and Stefan Kappler from ELEA Foundation. This event is actually kindly, or has been kindly co-organized with iGravity and Roots Capital. So it's thank you for helping to organize this and inviting us. This session is about mobilizing philanthropic capital into impact investing. And it's really the purpose of this session is actually to inspire philanthropic organizations, families, corporate foundations, to think about using impact investing as a means to scale their impact, which is related to the purpose of the foundation or to the goal that the individual actually has. So with this, I'm going to quickly give a bit of an introduction, and then we'll actually move to Deborah Schwartz. She is from MacArthur Foundation. That's a large US foundation. And given the different time zones, and it's 8 here, so it's about 2 in the morning at her place, she will actually give us a message over video. And then we'll have the other guests presenting their contributions. I always prefer to start with giving a bit of definition, because when talking about impact investing, it's not the same for everyone. So this is actually the GIN's definition. It's investments made with the intention to generate measurable positive and environmental impact alongside financial return. Just want to mention here that it's not only about private assets. Impact investing can be done in all asset classes, not only developing countries, but globally. And last but not least, financial return is an important characteristic of impact investing, but it can be on different ranges, also below market return, something we're going to touch on later on as well. And also, I would like to mention the characteristics is also given or defined by the community of the GIN, which is actually very broadly used. And these, the yellow mentioned expressions, I think, are really important to consider. Impact investments are done with an intention. And I think for all of you who are in philanthropy in some way or another, it's of course the mission that you have. Then it's you're supposed to use evidence when impact investing. So if you are looking for investments that are aligned with the mission or the intention, you cannot just do it with some assumptions. You should use evidence, like data, that underline that your theory or your activity is actually supposed to lead to what you want to achieve. Then that's very closely connected. You're supposed to manage impact, so you set goals, impact goals, you measure and you manage those. I think for anyone in philanthropy this is kind of normal, but not for everyone from the financial sector. I just want to give this very simplified message or a graph. The message here is actually that impact investing usually, or maybe for any traditional investor, it's clear that investments are being made through the assets portfolio, in the case of a foundation through the endowment. And that's already a way how to use impact investing to actually not only achieve financial return, but also impact. I added here two expressions that you will just hear in Deborah's contribution about mission-related investments and program-related investments. I'll use those a little bit later, but those are investments, of course, aligned with the programmatic work of a philanthropic organization, and which can have potentially a lower financial return target. That's especially true for so-called PRI. But then, what is for any philanthropic organization is actually different to a traditional investor, is that it has another pot of money, of capital, so to say, which is the charity work. And actually, with the program budget, there are also ways of how to use or how to promote impact investing and actually generate impact, but actually also leverage this work to create more impact, and also add to the ecosystem, which is actually, we're going to hear it, very important in impact investing. This is maybe a bit of a theoretical start. I think this will become a lot more tangible when we're going to listen to our guests. And with this, actually, I will move to our, first but remote guest, Deborah Schwartz. She is responsible, as she's the managing director of impact investing at MacArthur Foundation. The MacArthur Foundation has a very long history in impact investing, and they have today about $500 million US dollars allocated in impact investing. So she's going to give us a bit of a message of what they're doing, and we go for this one.
Thanks, Deborah, for accepting the invitation to our Building Bridges event.
Thanks, Miriam. It's wonderful to join you.
So we have a couple of questions to you for our audience, and I would like to start with this one. You have been with the foundation for over 25 years. Could you tell us a little bit more about impact investments at the foundation and how this developed over the years?
Thanks, I'm happy to. And even though 25 years does sound like an incredibly long time, the foundation's impact investing journey began almost 40 years ago. So a few years into the foundation's history, they learned about this new tool called a program-related investment that the Ford Foundation was starting to really experiment with. And in the late 1960s, they'd gotten the United States tax code revised to allow private foundations like Ford and MacArthur. And one other foundation was experimenting at the time, the Packard Foundation. And this tool, program-related investments, allowed us to pursue our charitable purposes, just the same as we would do grant making, but to do it with loans and investments, and eventually over the years with guarantees. And MacArthur spent really the next 15 years experimenting with program-related investments. And we did early groundbreaking work around sustainable agriculture, sustainable forestry. We helped support the very beginnings of the microcredit field, funding organizations that will go on to become very large and well proven and established. And in the United States, we funded access to credit for homeowners, for small businesses, for consumers, especially in communities that have been starved for access to investment. Communities because of racial prejudice or because they are physically remote, rural areas, all of them needed bridges, and that's your theme for your event. They needed bridges to the financial markets, and that's where we really focused our energy. And I would say that the next period of time from about 2000 to where we are, 2020, has been much more around institutionalizing our practices. So a couple of other things that happened along the way. We did an evaluation. The board affirmed its interest in doing more impact investing, but we set a cap, which is really a carve out of our endowment. And that was initially 200 million. And then it got raised, and it is 500 million today. So it's one of the largest allocations for any private foundation of our kind, because it's been 40 years. And overall, we've deployed about 700 million through the impact investing work, which today includes still mostly program-related investments that have government-recognized charitable purpose. But we also have a tool called a mission-related investment, which is not a legally defined structure, but it gives us more flexibility. As long as we're closer to conventional market rate profiles, we can have a little more flexibility in terms of the social good and the environmental good that we're doing. In addition to having the portfolio cap, we have an investment policy statement specifically for the impact investing team. And we have our own governance structure. We have our own committee that oversees us on a quarterly basis. We have, over the years, created a set of policies around risk rating, around watch lists and loss treatment. So we've developed a whole practice around how to manage these assets. We have a portfolio manager on staff. We'll be updating our policy statement and hope to share it publicly next year as a resource for other investors. And we have some grant dollars that we also deploy, about 5 million each year. And that's a companion to the investing work that we do and allows us to support the field of impact investing globally. So,
thanks, Deborah, for sharing this. Actually, this capital that you work with is called in the industry Catalytic Capital. Austin, as we know, for impact investing, Catalytic Capital plays a very important role. Could you tell our audience a little bit about what actually Catalytic Capital is and does, and why you focus so much on this?
But we think it's a way of capturing these following three things. It's always impact first. When you're picking your investment, the first thing you're thinking about, not the last, is the impact. What's the problem I'm trying to solve? Where's the capital gap? How can I make that impact come to life? So that's one. It's flexible. It's willing to be more patient. It's willing to be more risk tolerant. And if it's necessary, it's willing to take a lower return for the risk than an ordinary investor would accept. It's not always concessionary, but for us, in some of our fields, like affordable housing, it has been largely a below market type of investing. I think in the climate arena, we're starting to see some examples where that's not necessarily going to be true. So even inside Catalytic Capital, there's a bit of a spectrum. But it's impact first. It's designed to be flexible to fill gaps and solve problems. And then the most important part is it brings additionality, by which we mean it unlocks other investment. What you're really looking to do is, whether it's over time or in what we call blended finance structure, you're trying to make it possible to de-risk things for other investors, to let things build track records, proof points, scale, so that other investors can come to the door. And so that's how over time, we might seed an early stage innovative entrepreneur, and then they can over time be able to bring in more traditional kinds of investors. So Catalytic Capital, it is the bridge. That's how we see it. It's how we get from one stage of development one level of risk, how we can get to a place where more investors can engage. And it is, in fact, the type of impact investing we've been doing for 40 years, and many others have been doing it. But I think it was a very fragmented space. And I think we and others decided that it could be quite helpful, as the impact investing field was growing so rapidly, to bring some clarity around this topic, to build some evidence of its use and create some tools for practitioners and investors to take advantage of as they were going on their own journey, to just create more of a community of folks who might call it something different, because there are many names that overlap.
I think this message is incredibly important, and especially to our audience of Swiss foundations and philanthropists now in our audience. Now, I think our audience is keen on learning from you and the others, and maybe start their own journey or accelerate their journey in impact investing. What main message would you like to give them, or main recommendation?
Great, thanks. Well, first of all, I'm very happy to hear that they are all coming together, and they're coming together with you, and you're an experienced impact investor yourself. One of the things that we did then 2 years ago is to join forces with the Rockefeller Foundation and the Omidyar Network, who are also incredible leaders in impact investing, thought leaders in impact investing. And the three organizations came together in the spring of 2019. And we launched what we call our C3 initiative, the Catalytic Capital Consortium. MacArthur has made a set of investments, and they're all listed on our website. There's 11 of them that we hope are, inspirational and informative, and we're really excited about those investments. But then with Rockefeller and Omidyar, we have co-funded a pool of grant dollars, and that's housed at the New Venture Fund. So one message I have is stay in touch, keep watching the C3 page of the MacArthur site, visit the other linked sites, because we're going to be generating tools and knowledge and content. And if there's something you're really looking for, if one of the foundations in your gathering is really looking to answer a question and they're not seeing it, feel free to reach out. We have email addresses and things like that on the sites. And please reach out, because we'll be happy to share what we can, or to at least join forces trying to figure out where that information might reside. And, I think that I just really hope that the folks in your audience will think hard about this catalytic capital kind of deep impact first work, because it's a way to not only have meaning in your impact investing, but also to have a kind of outsized impact, to punch above the scale maybe of your balance sheet. So if you don't have a lot of resources to put to work right now for impact investing, the catalytic form might take a little bit more creativity and a little more patience and problem solving, but it could be very meaningful and very satisfying as a way to play what we call a but-for role. That but for your investment, that impact and that other investment would not be possible. So I'm really making a call to your folks to think about that but-for kind of role for themselves.
So thank you so much for sharing this with our audience.
It's my pleasure. Thank you so much.
Well, unfortunately, Deborah is not here to take questions, but she's really very eager to reply to you if you have questions by email. I think you can find her email address on the website, or just ask me. I'm really happy to put it through or put you in contact with her. She's just before we actually jump into the concrete examples, I like to mention here that probably not every foundation or not every philanthropic work can be leveraged through impact investing. There are certain topics, and especially the one that can be called frontier finance, which is linked to activities, helping especially the lives of low-income population in emerging and frontier markets, those kinds of goals can be achieved or leveraged actually through impact investing, but of course not every purpose. And all the examples that we're going to hear in a minute are related to this kind of activities, such actually also as Deborah explained for MacArthur Foundation. However, they're going to be a bit further and include climate as well as a topic. And the challenge is, and I think Deborah has mentioned, that the challenges linked to these kind of investments are quite substantial. If in a way that concerns raising capital, in a way also that there are often educational gaps, like people lack the knowledge or education, and also the operational costs usually are really high. That concerns managers, but also people like entrepreneurs on the ground. And for this purpose, exactly, this flexible capital is needed so much. And that's what we're going to focus on as well during the next presentations. And philanthropic organizations do have this kind of flexible capital to help overcome these challenges. So I think Deborah gave a very nice explanation of catalytic capital. The form of this capital can be very different. And I think one point I want to add here is that this capital can be recycled. So it's unlike a grant that is just basically gone. Catalytic capital can come back, maybe not with a return, but it comes back. I jump on this one. Just want to finish by giving you this overview. This should give you an impression of where impact investing and the catalytic capital sits in a broader spectrum of financial instruments. So clearly, impact investing has the goal to contribute to an impact goal, and catalytic capital even is a subset of impact investing, filling gaps which impact investing still does have. So with this, I actually move to Fabio Segura from Jacobs Foundation, who will give us a bit of a view of their work. Fabio, please. Fabio is the co-CEO of Jacobs Foundation, and we'll look forward to his contribution. Thank you.
Thank you. Can you all hear me well? Great. Good morning, everyone. We had a long discussion whether this panel was gender equal or not. So considering the pandemic and the time differences, we made a judgment call and said we're equally represented. One of the things that we want to start by discussing here is that impact finance has been around for quite some time. I personally started this journey some time back in 2008. And the first time I was invited to a conference in Latin America where I was an investment manager too, I said, if in 10 years from now we're still talking about impact finance, something has gone really wrong. Well, it's 2021, and I'd like to share with you some of the things that I feel has gone wrong in this space. It's not very appealing to start an impact finance panel, but I think we have to be very critical with ourselves in order to advance the field. Number one, I feel impact finance has been rather shallow on the evidence use. Miriam was mentioning that one of the features here is that you have measurable impact. But I have written hundreds of preliminary reviews, investment memorandums, when we say things like, if we produce X service to the less advantaged, they will save money, black box, and there they can send the kids to school. How many of you have seen this? It's like, well, if they save money on electricity, the more kids are going to go to school. So we have been very shallow on the causality links that we call impact. And that's one thing that I can see across all portfolios one can analyze. Evidence, for example, shows that there is a very high correlation between people who go to bed with their shoes on and people who have headaches. Right? And we can just say, hey, well, let's have a campaign about people not sleeping with their shoes on. But the correlation is not causality. The causality is that people who go with their shoes on usually have been drinking too much at night and therefore they have a headache in the morning. So, that's a little bit what impact finance has done a lot. It's just like, let's correlate these things and talk about impact very broadly. So impact finance has been very shallow and very naive and many times in defining the actual evidence for impact. I'll come back to this. Second criticism, impact finance investors have been too in love with the models, business models, financial models, the companies, and not enough in love with solving problems. So we look at the world through the lenses of a company. If I can make that company successful, impact will grow alongside business. That's been an assumption we've made for a long time, and it's not always true. Very direct examples, and I'll come back to this one as well. In the edtech space, in the last 3 quarters of this year, we've had the highest number of investments in edtech in history. It already smashed the 2020 record for how many billion have been invested globally in edtech. I think we are at 16 right now. However, less than 5% of edtech solutions have been tested for efficacy. So we don't know if these technologies are helping students learn. And so we just assume that if the business grows, impact will grow with it, but impact management has been rather sloppy. Impact evaluation has been rather sloppy. The bias here is that as an investor, if I invest too much on research and very rigorous evaluation, that capital is not very efficient. And that has been a bias. So we're just largely investing on assumptions, and we're more in love with companies than we're in love with solving problems and actually being accountable for the solution of that problem being systemic. And at the same time, systems change is an overused term across all of our annual reports. But how many of us are really working on the conditions outside a company that make it possible for that investment to be viable and generate those financial returns along solving a social issue? How many of us are building those systems that need to be in place beyond the company? That is the public goods, the understanding by the target populations that there are options, the regulatory frameworks and so on, the evidence itself that allows us to scale what works and not what is commercially viable. And in line with that, the third criticism of many one can make to this space is that very few, if impact finance is borrowing from traditional finance instruments and approaches, then we should see in impact finance a lot of the unicorns we're seeing in traditional finance. Companies scaling, multinationals becoming powerful and actually going cross borders in many geographies, solving issues left and right. That's what traditional finance has done in so many fields. So why are we not seeing this amount of unicorns and IPO organizations if we're borrowing all of the tools in that toolbox? There are many reasons for that. But one of the key ones here is that impact finance, in my view, is a pilot. This 10, 15 years of millions and even billions invested in impact finance should serve us as a pilot. You see, a little bit of money at a very controllable scale that we can use to test if something works. And if it does, let's pick that which works and bring it really to scale in a way that can actually break the linear growth patterns we're so used to. The next school being built or the next clinic being served is no longer the logic here. It's how we disrupt the growth line and go back to the full pot of money and try to influence what's happening there rather than sticking to, well, we're the good doers here, but all other capital or those trillions being invested in traditional finance, you guys can go ahead destroying the planet because we have impact finance. And that was what's gone wrong in the last 10 years. So with this, I'd like to introduce the Jacobs Foundation and what we're trying to do there. The Jacobs Foundation inadvertently became this year the largest philanthropic funder of K-12 education globally. And this year we committed 82 million Swiss francs to projects in advancing what we call variability in learning. In simple terms, it is how do we support systems, be it at a government level, at a school level, or in actual science and research that allows the systems to serve individuals rather than the average group. Education hasn't changed much since we invented it, and the world has changed a little bit since we invented education. So we want to help those systems cater to individuals and help each of us achieve our full learning potential. Of the $82 million that we deployed this year, 30 were in investments. And in the past, Jacobs Foundation, we did anything in the toolbox, from direct investments in companies. We have a fantastic company in West Africa. It's the largest African provider of education. They work on what we call dumb funds, and via text message actually help students compensate for lack of good teachers that are trained or present, and then they can actually practice for their exams, catch up on their national curricula, and is present in a few countries. So we did things like that, direct investments. We did fund investments. We supported the Regional Education Fund for financing of education in Africa. We did convertible instruments. So we gave a company a loan that if it were successful, it would become an equity investment, and so on and so forth. And in this year, we thought, well, we have long borrowed tools from traditional investment to use in finance. How about we borrow tools from what philanthropic foundations are doing and bring them to traditional investments? And so we decided to invest in EdTech-focused venture capital funds for a reason, and I already mentioned it. EdTech has a huge problem, which is that problem of efficacy. Number one, we don't know what's working, but everybody's supporting it, growing it, and buying it. Number two, we don't have a guiding compass as governments, as learner, or as a school director, as a parent, to know what is adequate for me, for my child, in this context, what works. We don't have a compass. Nobody's out there to protect us consumers on EdTech. And not only the financial risk is high, but the time we're investing in critical times of developing in life, somebody should have an FDA type of approval of what is being bought and traded in the EdTech space. And we feel that is a problem. Number three, if you look at the global users of EdTech, they're less diverse than the school goers. So we have mostly a very connected, already advantaged population that is literate, and that is actually in very specific parts of the world. But there are many unserved populations that don't have access to it. And lastly, we have an issue of access. So for many populations, it's either not in their language, not affordable, the technology is not adequate to their context, what they can access, or connectivity, or their context, the context of the apps, the problems they're solving are not problems of, say, Southern Colombia or Northern Côte d'Ivoire. What did we do? We said, dear funds in the space of EdTech, we found about 15. We're going to come and place philanthropic dollars into your fund. We're going to become LPs. And we're going to do that with conditions. And we're going to take that money not from our assets. We're going to take that money from our program funding. And the conditions are, number one, you introduce all of your upcoming entrepreneurs to the long history the Jacobs Foundation has of supporting scientists so that they can actually work together in seeing what science is saying works to actually develop these products so that they are more educational. So there's a dialogue between your for-profit commercial base of solutions and what science is saying works in this space. Number two, you're going to commit to source more deals from different markets, which, by the way, is actually good business because the normal markets you're serving are slowly becoming saturated. So the growth is going to be in Africa, in Latin America, in Asia. Within the already OECD countries, there are vulnerable populations that are underserved, and we want to see diversity in the user base. And number three, we want you to commit with other funds we're going to invest in to actually raise the bar in due diligence and post-investment to address these issues. So we're taking what foundations, philanthropic foundations care about and trying to influence the larger amount of money. And by placing that capital there, only on that, taking advisory board positions in these funds, we're probably going to influence more capital than we have to spend in the next 10 years in that one go. So that's what I'm talking about, impact finance being a learning tool that has missed the scaling part. So this pilot now has to go to scale. And my advice here and point to close is, as impact finance investors, we need to elevate our ambition and be in line with what the real transformations are in the world that are needed today and elevate our capacity at the scale of the problems being produced. So with that, I will close and pass it back to you, Miriam. Thank you.
Thank you. Great introduction. I'd like to take questions at this point in time. No. Yes, Laura. We're going to answer a little bit later, just for the flow, but we take the questions so they don't get lost, please.
Yeah, no, thanks. Thank you. And thanks, Fabio. It was a great presentation, and congratulations on the groundbreaking work that you guys are doing. I'd be curious to hear what the reaction was of some of these fund managers when you came up to them with some of these requirements, and how receptive they were to that influence and those conditions that you placed.
Okay. Yes, please.
Which capital did you use to invest in the existing funds? Did you use your disbursement capital that you have on a yearly basis, or your own capital? I'm not sure if it's clear, but it looks like you understood the question. Thank you.
Thank you. Great. Well, with this, I would like to. I'd like to welcome Stefan Kappeler, COO at ELEA Foundation. Looking forward to your presentation.
Thank you. Thank you very much, Miriam. Thank you very much, iGravity. Good morning, everybody. It's indeed great to see so many people, not only because of the early hours, but also because of what's happening on our planet today here at the Impact Hub in Geneva. I want to touch on three things in the next 10 minutes. I want to tell you a little bit about what the issue is that we address. I want to tell you a little bit about how we do it. And I want to tell you a little bit about it, what our learnings are. And I already got so much used to the mask that I even forget to take it off. I want to start off with a picture of our planet at night. You've probably seen it already a couple of times. But for us, it represents very nicely how wealth is distributed. And I particularly like to point out this little place here in the east, basically between South Korea, here Japan, and basically China. And there is a dark spot, which is North Korea, and which represents very nicely the state of economic development. Globally, around 1.2 billion people still lack access to electricity. 1.2 billion people still lack access to electricity. Around 2 billion people lack access to financial services. They can't save, they can't lend. And we all know that the population, or overall this results in about 30% of the population still living in absolute poverty, defined as less than $2 daily income. And if this is not already enough, we know that the population is going to grow by 2050 by around 35%. And of the 2 billion people that will be added over the next 30 years, around 1 billion is going to be born in Asia, and the other billion is going to be born on the African continent. And while Asia is about to grow from 4 to 5 billion, so by 25%, the growth in Africa means basically a growth doubling from 1 billion to 2 billion. And if we know that many African countries rank among the poorest countries already today, one could look at it and say, wow, this is a huge challenge that we have ahead. But on the other hand, you could also argue that there is a huge opportunity that lays ahead. And this opportunity is what ELEA tries to address. We are an active philanthropic impact investor that fights absolute poverty with entrepreneurial means. We've seen this slide before from Miriam, but just to orientate yourself, where do we see ourselves? So we see on the far right traditional investing, how the world has invested over dozens of years in the past. We see sustainable, responsible or ESG type investments that have grown tremendously and today are about a third of global investments that are done ESG related. And we have on the left-hand side traditional philanthropy, philanthropic impact investing and impact investing, where we as philanthropic impact investor address societal challenges, however, with very insecure returns. We are investing in this so-called pioneer gap. We call this for us proven startups and early growth companies. These are companies typically between 1 and 3 years of age, have revenues roughly between 100,000 and maybe $1 million, where the financial risk of an investment is very, very high. The ticket sizes are smallish. ELEA invests typically between 100 and 500,000 together with other investors. And where the need for non-financial support is at least as high as the need for capital. So we say, for example, for every dollar that we invest in cash in an organization, we invest another dollar for in-kind contributions, such as contributing as a member of a board of an organization and working together with the management team and other investors to help make this organization sustainable and create long-lasting impact. So in a nutshell, what do? We source and we work pretty much like a private equity firm in that sense. We source around, or we review around 600 ventures on an annual basis. We do this through desktop research, through spending time on the ground, a little bit less these days, and assess these ventures and invest in typically 2 to 5 ventures a year. And then we work together with these organizations over a period of 5 to 10 years, contributing to build up governance, to build up sustainable structures, so that at one point we can exit these ventures again. We engage philanthropic capital, our own philanthropic capital, but also philanthropic capital from private individuals who share the notion of fighting absolute poverty with entrepreneurial means, other institutions and other companies, family offices, but also companies like Accenture or Julius Baer, who invest in us. We are a tax-exempt foundation, so the investment is, from a legal point of view, a donation to us, but then basically is invested from ELEA into our portfolio organizations. And then we contribute to building an ecosystem. We run, and I think we're pioneers in that, an ELEA talent program where we build, or where we provide young talents the opportunity to pursue a career in impacting or in philanthropic impact investing. And we have a chair for social innovation at IMD Business School here in Lausanne. We were founded in 2006 and became operational in 2008. And since then, we've done 40 investments across grants, loans, and equity in Latin America, Sub-Saharan Africa, India, and Southeast Asia. And while we were able to grow our impact, and we measure that with our own impact measurement methodology, the EIMM, and we grew the impact to more than 1.2 million impact points. And you see that in the gray bar to the right. Last year, the impact came at the cost. This is the red curve that you see. This is our ELEA return on investment that we measure on an annual basis. And we see that while we were able to grow the impact, we obviously had to deploy much more capital to reach that impact because of the pandemic. So I want to close off with some learnings from our 15 years journey. We call it the ELEA way. We summarized it in a book. I have a few copies here with me. You can also order it online. If you care for a copy, as I said, I have a few copies here, and please reach out to me after the session. So first of all, this is hard work. Many people think about foundations as, they sit there, they review the proposals, and then they distribute money. But this is no difference to any professional business out there. And if you apply the same rules, the business rules that you have out there also to philanthropy, you will be successful, no matter how you do it and what you will do. It's incredibly rewarding, especially in times like this, when you work together. And our portfolio at the moment consists of 25 impact enterprises. And if you work together with the management teams, with the founders, with the CEOs in South Africa, in India, in Peru, in times like this, and they really prove why they are entrepreneurs, because from one day to the other, they have no cash flow anymore, but they have a team, they have people at the base of the pyramid that they employ, that they provide services to, and they have to find solution and adapt on a changing situation all the time. And if they succeed in doing so, this is incredibly rewarding. And we see that not also in our daily work, but also when we speak to talents at top universities. The zeitgeist is really there for many of the young talents to pursue a career and to contribute their energy and resources for a meaningful career. As we said in the outset, philanthropy is between, on the far left, traditional philanthropy, grant giving, and impact investing. So there is a continuum there. This is not a contradiction, so there are possibilities. And we just urge everybody who has the possibility to be open to that and try to pursue different things. We don't say that equity investments or loans are always the solution. There are very many areas where it doesn't work, where grant is the right approach. But there are also very many areas where grants are the wrong approach and where more business-like instruments, commercial instruments, have a much bigger lever. And after 15 years, obviously, we only scratch the surface. There's more potential ahead. And if our scarcest resource, basically social entrepreneurs, if there would be more out there, that would obviously make our life much easier, because this is for us the toughest job. We have, we think, a successful proof of concept after 15 years of what we do. However, challenges exist. One question, for example, for us is how do we scale our business model? It's a very one by one. If we hire 5 more people, we can source more ventures, we can place these people on boards and we can work together with them. So how can we grow that? The whole exit story, Fabio and I know each other for 10 years or so, and at the first conferences that we attended together, the discussion was always, how do your exits look like, etc. 10 years later, we still talk about the same thing. So the question there is really, how can we, this continuum that we saw at the outset, how can this continuum grow, and how can commercial impact investors, so this is a question that we ask ourselves, how can commercial impact investor start investing in portfolio ventures that we have? And what we think is a bulletproof business model and is a highly successful venture in our portfolio might be for a commercial impact investor still too dangerous and not secure enough, and maybe let's wait another 2 to 3 years until we really start engaging. And then innovative approaches for continuous growth is required. For example, how can we scale successful models? How can we replicate successful models? There's still a trend out there that everybody tries to reinvent the wheel. And how can we work together, closer work together, and say, okay, this has worked in one area, and how can we replicate in the other? With that, I close here, and I very much look forward to the questions and the discussion afterwards. Thank you.
Thanks very much. Thanks, Stefan. Really inspiring. I'd like to take questions here for Stefan. Yes, please. Yeah.
What made you decide to pursue direct investments into ventures and not going over fund investments? So what is the USP you think you have compared to like VC funds that invest for you into ventures? So where's the gap?
I take advantage that you're close to me. And my question would be on the impact points. Can you tell more about your impact measurement methodology? Because, of course, 1 million impact points does not mean much to, let's say, an ordinary person like me. Okay.
Thank you. Well, with this, I would like to welcome Lukas Schon. He's head of advisory at iGravity, and he will talk about the ILFF.
Thank you, Miriam. And on behalf of iGravity and the Impact Linked Finance Fund, the ILFF, it's a pleasure to be here. So I must admit, I have a few years less on my CV than my colleagues before, but I certainly share some of the thoughts that were already mentioned. And it's without doubt. Where do I need to point? Okay, here it is, thanks. So without doubt, impact investing is booming. We have here some headlines. It has become clear that it's an investment topic that is becoming mainstream. I don't want to open the debate what counts as impact investing. Is impact washing greenwashing? I want to ask one question, and this is impact investing or private investments reaching the least developed countries? So there where the financing gap is the biggest, and also, but at the same time, the potential to create impact is also really big. Well, short answer, no, it's not reaching. There are many reasons for that. Of course, risk aversion, barriers, political instability. But at the same time, there is also one important question to ask. What's the proportion of institutional impact investors willing to sacrifice financial returns, but for higher levels of impact? Any guess in percentage? 20? It's not too bad. It's a bit below, actually. It's 15%. So this is from the GIN Annual Impact Investor Survey. We see that only 15% of institutional investors are willing to sacrifice financial return or just to keep the capital to achieve high levels of impact. I'm not saying this is bad, but at the same time, we need more institutional capital to flow into these countries and also enterprises. So what can we do about it? Well, this graph was similarly shown already. You all know it if you took any economics class, the risk-return efficient investment frontier line. And many of the projects, enterprises we talk today are below this graph. So either the risk is perceived too high or the returns are perceived too low for the same amount of risk. So what can we do to bring these enterprises up to the investment frontier line and make them investable and interesting for institutional investors? Or put in other words, what if entrepreneurs around the world would get remunerated for all the social value, the impact they create? And one answer might be, well, let's use financing and combine it with impact terms. And that's another new term. I'm very sorry to introduce that, but that's what we call impact-linked finance. So financial solutions, instruments deployed to high-impact organizations, but which are linked to terms that must be fulfilled so that the financing get released or certain things can be changed. And of course, these are either positive, of course, social or environmental outcomes. Just a few basics. How do we design these impact-linked finance instruments? And I will speak about two examples in a minute. But overall, of course, we are speaking about financing to private enterprises. That can be social enterprises, SMEs, could also be NGOs with some kind of a business model. The important thing is that the enterprises are able to generate a cash flow. We focus on outcomes. It was already mentioned, efficacy, effectiveness of impact is very hard to prove and calculate. If we achieve already outcome-proven investments, I think it would be a huge step. We provide incentives to the value creators, so to the entrepreneurs, to the enterprises. And last but not least, and I think this was also mentioned by Deborah in her video message, the additionality. So really to create the impact that wouldn't have happened without this impact-linked finance instrument. Two examples of such instruments. Maybe you have already heard of the social impact incentives, SINC. It's an instrument that has been pioneered by the Swiss Development Agency and Roots of Impact, the other initiator of the Impact-Linked Finance Fund besides iGravity. And in very short, the basic idea is that an impact enterprise is raising external investments from traditional or even philanthropic venture capital. And of course, this investment at some point needs to be repaid. We all know that. But at what cost? So often these enterprises, they have found a niche and they are raising investments, and there might be the risk of a mission drift, so that they are not focusing, for example, anymore at the very low income households. And there the SINC comes into place. So we have an outcome payer, for example, a donor organization or a foundation that rewards the impact enterprise to keep the mission, but at the same time is able to raise external investments. And of course, it's not something that the enterprise can just say, and we check the annual reports. No, there is an independent verifier that really goes through the business model, talks to the people, talks to clients, and verifies all the information. Only then the payments get released. The second instrument is called Impact-Linked Loan. I think that one is more straightforward. So there is an investor. It could again be a foundation, a donor, but even a more traditional kind of investor that provides a loan to an impact enterprise, really to be paid back in 3 or 5 years. But there again are conditions. So if the impact enterprise achieves or surpasses certain KPIs in terms of outcomes, the interest rate can be forgiven, for example, or it can be lowered. Or even the whole loan amount could be forgiven. And with that, there is an entrepreneurial incentive to work with a loan, but at the same time, the impact enterprise is also incentivized to achieve as much impact as possible. And again, of course, there is an external verifier to this. So this all sounds nice in theory, but how to put this in practice? Well, that's the question that iGravity and Roots of Impact asked ourselves. And almost 2 years ago, we founded the Impact-Linked Finance Fund, a foundation based in the Netherlands, a stichting, which is able to attract funding from private and public organizations and transform it into impact-linked finance instruments, which then are deployed to the impact enterprises. And of course, the goal is, first of all, impact shouldn't be at the bottom here, should be at the top. And secondary, also, if possible, some kind of repayments. So really the recycling approach, so that a certain part that comes back could be recycled again. What have we done so far? We have launched 2 funding windows. Today actually marks the day of the launch of the second funding window, the Impact-Linked Fund for Education, where we are very pleased to have Jacobs Foundation on board. Before that, we have launched another Impact-Linked Fund with the Medicor Foundation and the Swiss Development Agency. And we are currently working on a third Impact-Linked Fund for gender-inclusive fintech. This is still under design, so if you're interested in the topic and would like to contribute, please approach us. As you can see from the target regions, we are working with entrepreneurs, companies in the Global South, and also across sectors, we are targeting a variety of areas. I'd like to close with an example, because in the end, it's about the entrepreneurs, it's about the companies that create the social value. And this is actually an impact-linked finance investment that was approved. It's called, the enterprise is called Kilimo Fresh, based in Tanzania, working in the agricultural sector. And what they basically do, they source raw materials, food supply from farmers and bring it to businesses, restaurants, hotels directly. And I think one important thing, they try to leverage technology as much as possible to avoid, for example, food waste. As you can see, a very nation company, not too big, but at the same time they were already able to attract co-founders, most namingful Seed Stars, an accelerator that you might know, headquartered here in Geneva. Last but not least, why is this enterprise interesting for the Impact-Linked Finance Fund? Well, besides the obvious reasons shown here above, the target group with whom they are working, they would also like to work with more informal vendors in the main capital. But there again is the challenge of mission drift. So this, of course, requires high amount of investment and is very risky. So basically, it's an ideal case for the Impact-Linked Finance Fund to come in, allowing Kilimo Fresh to raise external investment for their more traditional growth plans, but we can support them by achieving this potential impact reward. And with that example, I close and hand over to Miriam.
You can just take a seat. No, just take a seat here. Just collecting questions for Lucas. Oops, many. Thank you.
Can you tell more?
Oh no, you cannot. Sorry.
Can you tell more about impact investing in Can you tell more about impact investing in healthcare sector, especially any successful experience, if already in this fund that you just mentioned with Medicor and DDC? Thank you.
Thank you. There's questions just here.
Hi. So my question is around processes. The biggest challenge in financing or in financing project is the time it takes for when you start assessing the project up until there's closure and the funds are dispersed. Because in a lot of small to medium enterprises, sometimes if you delay the process, the market would have moved. When you deploy the money, sort of the market is gone, such that the entrepreneur doesn't have the first move advantage. How do you ensure that, or how quick are your processes? So this question is for all the team here. Thank you.
Hello, my name is Johan Frostling Dynamis. We have a problem with investors that saying that no, we only invest in Northern Europe or Central Europe and not in the developing countries. As you say, it's very low. And indeed, there are impact investment associations in some of the countries that say that, no, we are only doing it in our country. How can we change that?
Thank you. You can come forward.
Hi, and that's one? Okay. So I'll be curious to hear from them, from Lucas, Fabio, and Stefan, how they manage the FX risk component, right? Because I guess that in foundations, especially when you invest equity, controlling for that part of the financial return or potential financial return is not possible. So you guys have a bit more flexibility, perhaps compared to the fund that Lucas was describing. But I'd be curious to hear your perspective around how you incorporate that.
Thank you. Well, there is opportunities to ask questions as we go. Thank you so much. So we're going to start answering and discussing. Yes, you're allowed to take off. I'd like to start with the first questions about how, like you said you were working with fund managers. how was the reaction of these managers?
Thank you. Well, the reaction has been varied. Firstly, we're asking for things that are good for business. Go to markets that are emerging and that are growing. And so, if you are acting in a saturated market and you want to be in business for a long time, you might want to go there in the first place. The second thing we're asking is for evidence about efficacy. What markets do well and what impact finance has done very well that philanthropy hasn't done so well is to rule out bad quality products. So over time, when you're paying for something, if it's not working, you stop buying it. In philanthropy, in traditional charity, if you're being given some for free and if it's bad quality, nobody's there to rule it out, right? But if we tell the funds, we want your products to be more effective in actually delivering on their promise, and these funds are smart about being in business for the long term, this is not crazy. So they are open to that. Where we're finding more difficulty is in marrying the return expectations with the open science principles, so creating public goods out of private investments, and also to elevate the entire ecosystem and the quality of the due diligence process across all the investors in this space. We're yet to see that. One of the things that we're doing, and I see my colleague John here in the back, who's brain behind this initiative. One of the things we're doing here is partnering with other foundations and going to the funds as a collective and saying, we are all foundations that want to place capital in your solution for impact. So when you talk to us, you're talking to a group of us that has a financial muscle that none of us individually has. And if you want to be given a seal of approval by these impact-first investors now that your other investors care about, then let's talk business and let's talk about these conditions as a normal new way of doing business. So we're trying to do smart things about it. And one last thing that we're doing is we're using all of the proceeds from these investments in funds to fund research. So to have more capital to do better research in this space. The other question that somebody asked was about what kind of capital we're using. We're using restricted funding, which means for a foundation, we're not taking this from the asset management perspective, we're taking this from the programs perspective. So to justify this also legally, because in the book it says you shouldn't, as a foundation, do fund investments. We're basically turning it into a program where we actually go there to learn and to share those learnings with other parts of the world that are not receiving venture capital funding today, but nonetheless have worthy entrepreneurs of supporting and worthy solutions that need to be also elevated with intellectual capital. And the last thing is, as I mentioned before, that we're recycling that capital. But this is funds from the program side.
Maybe I'd like to hand over the same question to Stefan. What capital do you use for your activities?
I mean, if you allow me also to combine it with one question from the audience, in a sense, why don't we invest in funds and have them deploy the money, and why do it ourselves? So we started off with 20 million Swiss francs. We have more than doubled that with external support that we received from a little bit more than 3,000 philanthropic investors. And for us, this has basically defined the ticket size, and you remember the graph that I showed you, basically this pioneer gap that we identified as a critical phase in the journey of an impact enterprise. There are enough business plan competitions, prices, etc., that are incredibly valuable and that help basically an organization to get additional funding besides the triple Fs, the family, fools, and friends. However, and foundations maybe, exactly, 4 Fs, exactly. However, then basically until you have a certain track record, there is a gap, and this gap exists on the one hand side of funding, financial funding, but there is also this really, really huge need of in-kind contribution. And one of our due diligence questions, we look at 4 things when we do a due diligence. I mean, obviously we look in what region it is and does it fit our investment themes that we have. But do we believe in the business model, and do the financials somehow make sense? And not all of the financials need to have a black zero in the end or even a high profit. there could be good reasons why this can be a loss-making enterprise that needs to be covered by a certain amount with grants going forward. The second thing is the impact, obviously, they create. Is the impact big enough, base of the pyramid population? The third thing we look into is the team that is behind it, because in the end, we rather invest in an A team with a B idea than in a B team with an A idea, because we all know we can't change people, but we can change the ideas that they implement. And lastly, we look at what is our contribution as ELEA, as an organization, to make this organization successful. And if an entrepreneur, and we have that over and over, they approach us and say, the only thing we need is money. And he said, fine, but then you don't need us. Because we don't share that notion that the only thing that someone needs to become successful is money. We really believe in collaborating. We also always take minority stakes in an organization, and we always want to partner with other investors because we believe only together we can be successful. And now coming back to the initial question, we started off initially with doing 100% grants of our assets that we had. And we realized that over time that this creates in many instances a wrong incentive scheme. Because it's a complete different thing if I give you $100,000 and say, this is what we think you should do, and you say, this is what I agreed to do, but you know there are basically no strings attached. Loans can work, typically in agricultural space, for trade financing, to bridge harvest seasons, etc. But a very strong entrepreneurial mechanism is equity, because you ultimately share, obviously, successes. Yes, it's true, but I rather have a very minor stake of a highly successful company than just keeping 100% of a not successful company. And on the other hand, you share the risk. And it's a fundamentally different thing if you sit in the same boat with an entrepreneur and both know we are married together. And that's why it's so important that we as an investor do a due diligence on the entrepreneurs, but also the social enterprises do a due diligence on the investors, and that they really need to make sure with whom they want to work together with, especially in the sector we operate in.
Yeah.
May I?
Yeah, sure.
You're challenging the trust-based philanthropy movement. I get this question all the time, so I'm going to be very provocative here, where it says, it basically argues, you know, the best philanthropy organizations that are really truly for impact should just give them money because the poor and the social and local organizations know best what impact is, rather than having somebody come from Switzerland to tell them what to do.
As I said initially, I think it really depends.
I don't believe in that, by the way. I just want to hear somebody else's answer.
And I mean, we've heard, or we read Andre Hoffmann a couple of weeks ago in a big Swiss newspaper where he said classic philanthropy is dead. Right? We could argue now, is this the case or not? From my personal perspective, I don't think so, but I'm a strong believer that classic philanthropy is not always the best solution to, for example, fight SDG 1 absolute poverty, right? And so for us, it really depends in what is the end goal, right? And we never, and that's why we also don't have people on the ground, and we don't get engaged in operational questions, because we don't know what a business in Tanzania needs to do in order to access their customers best. They know that better. They know the customers, they know their suppliers, they know the logistics mechanisms, etc. But when we speak about governance mechanisms, about setting up efficient reporting, about structuring financial deals, new funding rounds, I think these are things where we more or less agree how these things work. And this is something where we have a lot of knowledge and can bring them to the table.
If I also may react to your claim, Fabio, I think it's also about respect, you know. I think a grant in the end is free money. I wouldn't say that something free has no value, but I think if you start working with entrepreneurial methods that have proven everywhere, with equity, with loans, I think it's also a sign of respect towards an entrepreneur who is really trying to achieve sustainable solutions, creating jobs that will be there for a long time, and not only for the next budget cycle of a foundation or a donor organization.
Thanks. There was a question on the process, investment process. A question to you, Lucas. How fast do you have to be?
Well, it depends who you ask, of course. So I think we are in a special situation since we are trying really to bridge the gap or the river or whatever between public and private organizations. I think for private organizations, I think foundations are more patient, but if we would work with impact investors, it needs to go fast. At the same time, we work with donor agencies like the Swiss Development Agency, where things take a bit more time. So that's one challenge. On the entrepreneurial side, I think it's the same. In the end, the money needs to be there fast because the plans are there and they want to really do it. I think at the same time, it's also our privilege to take a step back and take the amount of time that is necessary to make sure that the impact part is also researched, is based on evidence, and then is really put into KPIs that are realistic to achieve.
Thanks. I'd like to come to another a question that is more related to impact, and it was named ethics. And exits were mentioned earlier, and I mean, we have to come to this topic, I guess. You're all somehow helping to create and grow the ecosystem, and you are ready to, or with your activities, you grow and support enterprises in a very early stage, and you want them to make investable or investment ready. How do you ensure that after you have been invested, they can keep their spirit and their mission, and that you find the right investors or shareholders for these companies in a later stage? It's an open question to any who would like to answer.
Do you want to answer the exit question again?
Well, they haven't heard the answer.
As Jacobs Foundation, we have a number of instruments, as I mentioned before. So some of them have exits. Some play a different game than exiting a company, and is growing the value over time. So, one of the things that I've learned from John, who's sitting in the back there, is that sometimes. Do you want to answer this, John? No. Okay. So sometimes it is actually more valuable from an impact perspective to hold an investment longer than a traditional investor would, until that company is actually strong enough on its systems, on its processes, on its management team, on its value proposition to stand the winds of future investors, no matter where that capital comes from. And if they actually do a good job there, it shouldn't matter who is buying into your shares in the end of the day, or if they are buying or rebuying your participation, which is also a model. And so that's, my take is, how much value can you create during the time you hold the investment so that the organization can go on independently of who comes in next. If an organization shifts like the wind with every new holder that comes on, then you have probably done something less than adequate for them while you were holding the investment.
Thank you.
Yeah, I fully agree to what you said, Fabio. I think on top of that, all the founders that we come across, independent of if we invest or not, are very intrinsically motivated to, in our case, fight absolute poverty. So this is really their main focus. So it's not, they're well educated in many cases, they could get corporate jobs, they could have fantastic careers, they could do something else. It's not that this is, okay, I didn't find anything else, so I become an impact entrepreneur. This is a deliberate choice. And I believe that they really take care with whom they collaborate, so it's important to them what kind of investors they want to have, and they will always make sure that there is no mission drift to what they actually want to do.
I think for us the question is less relevant because the ILFF is not yet doing equity investments, but still I think you have that with loans, also with Zinc. And what we do or what we demand is a clear view on the future business model of the company. So either they are able to generate revenues, cash flow in the private market, that's one option. The other option, which often applies with the type of companies in healthcare, in education, is that they are working with governments, and I think their contracts, memorandums of understanding are important to make sure that the company is not left alone when we when the loan is repaid, and yeah.
Thanks. A question to impact. There was a specific question to the impact framework of ELEA Foundation, but anyone welcome to say something about how you measure impact. Maybe is also linked to the question, is there a difference between what you do with the charity work and investments? So, but please, Stefan, start.
Shall I go ahead? Then I'm curious to hear how.
I'm still trying to understand the ELEA impact points after all these years.
Well, I don't want to. I mean, we could fill a whole session only on this, but I think what was important for us when we started in 2010 we started with the EIMM, but that we find a way how we could quantify impact across our portfolio. And we don't say that the solution that we have implemented for us, developed for us, is the best solution. And there are many models out there, you are aware of that. But what we have seen that it works very well for us. And what we look at it, or what we try to do is basically, when we started, we saw that there are organizations that count the number of people that they reach. And this is fine. If you have just one kind of activity that you do, then this is sufficient. You can say, we have reached 10,000 people this year, and next year 15,000 people, because if you only did one thing, then this is a substantial growth, and you can communicate that. And on the other hand, you have UN organizations, large donor organizations that do 2 to 3 year impact assessments that are incredibly interesting to read, but are also incredibly expensive. And then you can ask yourself, as a small organization, yes, exactly, yeah. But it's interesting to read, as I said, and very valuable, and very, very valuable. But in the end, as a small organization as us, we have to ask the question: is this the right way to spend our money? And so we came up with something in between, where we basically look obviously also at the number of people that we reached, and then we have different levels that we take into account. We call them a benefit factor, which is basically the individual level, where we look at the intensity and continuity of the impact. We have the edge factor, which is innovation and transferability. We have the sustainability factor, which is the economic viability and the execution capability of the team that is involved. So in summary, we have the individuum, the concept, and the organization that we look at. Then we have a risk level. Depending on topic or countries, we have investments in Zimbabwe. That is a pretty high risk just from an economic point of view. And then we have the ELEA leverage. If we sit in the board and we are a lead investor, we have a different leverage that if we are a minor investor and the organization is rather more on the early growth side. And this is a multiplication. We have handbooks for that, where we go through this, and which allows us to compare within our portfolio the different investments and come up on an annual basis with impact points to track, basically, did we grow and at what cost, or didn't we create any impact? But I'd be curious actually to hear what you have in mind when you started, just right, and how do you track it, and you have so much experience.
Yeah, I can summarize it in 2 sentences. I think do it, but don't get crazy. That's one sentence. And the other one is keep in mind what it means for the entrepreneur on the ground. Often they are not equipped with the reporting systems. They need help. It's in relation to what they're doing is a big hurdle. And I'm sure Fabio...
For Jacobs Foundation, the golden standard in evidence is independently replicated randomized controlled trials, very expensive, but establishing the causality between an intervention and its claimed impact. And not only in the intervention, but disentangling the different components of it to see which ones are really driving impact. Good news is that this is all published. It's all going to be at the service of those who don't fund it. And there is a growing body of evidence in almost all the fields we're discussing here, and we're just not using it. It's out there. It's out there, and we can just learn from it and implement it. And the other good news is that there are new methods, for example, innovation for poverty action, which we're going to use to actually measure the impact of the ILF. It's not so focused on RCTs, but are doing right fit for purpose type of evaluations that are a lot lighter, by using the rigorous approach of our RCT design, almost on a lighter basis and more economic to fund.
One last question. A very quick answer. No, but we hope obviously that with this session we have been able to inspire some of you to think about some activities you could start. What's your recommendation of someone who has gotten inspired? What should they do next?
depending who you are. I mean, there are so many roles that can be played in this space, from entrepreneurial approaches to funding approaches to working with those approaches, like you were promoting. More bright minds, more committed people are needed in this space. And for those of you who are not in the impact finance space, but in the traditional financial space, there are so many lessons that can be transported and so many ways of scaling what works here that can be transported across worlds. And that would be my invitation, is when something doesn't make sense at the onset, usually you're onto something really cool and really impactful.
I fully buy into that, and I would say get together, speak to each other, exchange, and find ways how we can solve these challenges, these SDGs that are out there together, without trying to reinvent the wheel. Be it as an investor, as a capital provider, be it as an entrepreneur directly addressing issues, or being as a young talent or even elder talent as we are now, and really contribute our career or dedicate our career to these issues.
Yeah, don't be afraid. Trial and error, connect. I think I would summarize it like that.
Thanks, Lucas. This was a very good point in the end. I'd like to thank you, Lucas, Stefan, and Fabio for this. And also, I'd like you to encourage maybe to visit the GIN's homepage, where there is actually also research work on the topic. And sorry if we haven't been able to answer all the questions. I realize this, but I think our guests are still here to take personal questions. Thank you.